about the fact that they did beat on revenue at $5.93 billion. Earnings came in definitely a miss, 11-cent miss per share. We're talking about Q4 guidance, though. Revenue was roughly in line at $6 billion, give or take. It was a little bit lower, but let's call it in line. Gross margins, adjusted gross margins for the fourth quarter came in at 66%, which is stronger than what the street was anticipating. One of the numbers that I was just looking for right now came in for data center revenue. So remember, we talked about that earlier today. Will data center revenue offset weakness in gaming as well as mining? So data center revenue came in at $3.83 billion. The street was expecting $3.72 billion, so that's definitely some strength over there. Management quote thus far in just the note we're seeing from the CEO of Nvidia saying that they are going through and correcting inventory levels and paving the way for new products, much like we've heard before in the past. And so, yeah, those are the initial numbers that I'm seeing just now at this moment.
Pop back on with us when you have a chance to look through a little bit further. Hear anything else, let us know. Josh Brown, I go to you again. All right, so data center revenue is pretty strong, good, reasonably good margins. Maybe not the, fall out of bed story that some were, I guess, worrying about.
Yeah, but it comes back to the bigger issue, which is that Nvidia was expected to have 120% plus earnings per share growth this year over last year, but only 30% expected for next year. So what do you pay for a company that has leading edge technology and is poised to dominate many of their end markets for a decade to come, purely based on patents and a lot of the stuff that they've put into place, but is selling at a multiple of 42 currently? Like, are you willing to pay that premium thinking that even if growth slows down next year, in the out year, it could reaccelerate as some of these technologies start coming back online after an adjustment? Like, you have to answer that question for yourself. That's not for everyone. So I'm a long-term investor here, and I am willing to stick it out. And I've been through multiple 50% drawdowns in this stock, not just one this year. It's a feature of owning a high-growth company.
All right.
So that's where I am. But for a lot of people, it's too expensive still, even given how much it's come down. And the growth next year that's being expected is not going to be enough for them.
All right.
So that's why it's a market.
Appreciate it, everybody.